Good afternoon, everyone. I'm Aishwarya Singh, and it's an absolute privilege to welcome you to Crystal Gazing 6.0 Decoding the Next Bull Run, PMS AIF World's sixth annual event. What began 6 years ago as a thought leadership initiative has now evolved into India's most influential summit for the alternates industry, a space where vision meets
And
expertise
it's an
and data meets conviction. Today, we uncover the roadmap for navigating the next phase of India's wealth creation journey. Crystal Gazing is not just another investment conference, it has become an annual tradition, a trusted forum where investors, fund managers, and industry leaders come together to gain clarity in an uncertain world. It is where we decode market complexities, identify emerging opportunities, and challenge conventional thinking to stay ahead of the curve. At PMS AIF World, we believe that true wealth is built on three pillars: quality, risk, and consistency. This philosophy underpins everything we do, guiding our approach in managing rupees 1700 plus crore AUM across 600 plus UHNI and NRI families spanning 25 cities in India and 5 countries worldwide. Our commitment is simple: empowering investors with transparency, expertise, and deeply researched insights. We pride ourselves on being your advisors in navigating the world of alternates with transparency, expertise, and insightful analytics. We at PMSAIF World help you make informed investment decisions. This year, Crystal Gazing 6.0 wouldn't be possible without the unwavering support of our esteemed partners. It's an honor to have 16 industry leading firms joining forces on India's most trusted alternates platform. Our partners are Title Partner ICICI Prudential AMC. Platinum partners are 361 Asset and Ampersand Capital. Our gold partners are Alternates by Axis AMC, Carnelian Asset Management and Advisors Private Limited, Tata Asset Management, White Space Alpha, and Right Research. And our silver partners are Blink Investment Management Private Limited, Generational Capital, Invasset LLP, Neogen Capital, Prudent Equity Private Limited, Code Invest, Sundaram Alternates, and Volvin Limited. This incredible lineup reflects the growing strength of India's alternates ecosystem and the collective mission to create sustainable wealth in a rapidly evolving market landscape. This event is spread across 2 days, today and tomorrow. And for the next 2 days, we have curated a power-packed agenda featuring insights from 40 plus leading PMS and AIF fund managers. They will share their strategies, perspectives, and actionable frameworks on navigating India's next bull run. So expect deep dives into identifying the next multi-bagger opportunities, mastering risk-adjusted returns in dynamic markets, decoding macroeconomic trends shaping investment strategies, and exploring new age investment themes in the alternative space. For our virtual attendees, we've also designed an immersive experience with an exhibition hall, breakout rooms, networking lounges, and interactive Q&A sessions. And I encourage you to explore these features and make the most of this summit. Now, we are on board a very extraordinary journey. I'm going to bring to you our first session, which is going to be an unmissable one. But just give me 2 to 3 minutes to align our first speaker for the day for the first session. Stay with me. Don't go away anywhere. So let's begin with the first session of the day. The topic for this session is Equity Outlook 2025, Resetting Expectations. As we stand on the cusp of a dynamic and evolving market environment, it is essential to recalibrate our expectations, challenge assumptions, and understand where opportunities and risks lie in the coming year. This session is designed to provide a balanced perspective on what's ahead in equities and help us navigate the road ahead with clarity. To lead this important conversation, we are so privileged to have in our midst Mr. Chockalingam Narayanan, Senior Fund Manager, PMS Equity at ICICI Prudential AMC. Mr. Narayanan brings with him over 17 years of extensive experience in fund management, investment research, and market analysis. He has been instrumental in deriving actionable insights from business fundamentals and providing detailed analysis of the macroeconomy, financial markets, and ESG trends. His diverse career journey includes roles at leading organizations like Baroda BNB Paribas Asset Management India Private Limited, Deutsche Equities India Private Limited, and Batliwala and Karani Securities. Academically, Mr. Narayanan holds a postgraduate diploma in management from TA Pai Management Institute, Manipal, a Bachelor of Commerce from G.R. Damodaran College of Science, and the prestigious FRM certification from the Global Association of Risk Professionals, USA. With his deep expertise and proven track record, Mr. Narayanan is here to help us decode what lies ahead for equity investors in 2025. Mr. Narayanan, welcome, and the floor is all yours. Over to you.
Thank you, Aishwarya, and thanks a lot to PMS AIF World for giving us the opportunity to present at this important event. I'll try and cover our equity outlook for 2025. Resetting one's expectations is the topic. Uh, there are two constants which the way we kind of see with regards to the equity markets, particularly whether it's the Indian equity markets or the global equity markets. What you can clearly see is it's a high risk asset class, but then in the long run, because you're effectively a equity owner, part equity owner in a company through the journey. But it's not a easy ride, given that the cash flows for an equity business tends to be volatile. So as a result, you will always see that this journey is always volatile. You cannot wish it away. So when you kind of look at this long-term journey, even for Nifty or Sensex in the long run, even in India, you would see that from time to time we do have pretty large drawdowns. In history, you've kind of seen that on an average, every year there is one. On an average, there's about one instance of 20% sort of correction. Once a year, you could say, and 30 instances over the last 34 years. You've had this, and over 10% corrections when you kind of look at it, you've had it at least 3 times a year on an average. Okay, so this is how volatile the market tends to be. It doesn't mean that every year it has to fall 3 times or every year it has to fall once 20%. But there are periods that you have it successively, and there are periods where you don't have it. Like for instance, over the last 4 years, when you kind of look at between post the COVID period for about 4 years, you hardly have one instance of more than 10% correction. Now is where we are seeing the second instance of that correction starting to has been there. So I think while this correction has started, it's a it kind of masks what's lying underneath. So that's where the opportunity also lies. Typically, these drawdowns are where the big opportunity is actually from the next set of when you kind of look at the longer term cycle. That's where it kind of sets a base for the next leg. And in that sense, it's actually pretty important. So while at a index level, when you kind of look at even till end of January, when you kind of look at Nifty 500 having fallen about 11.9% from their 52-week highs, what you'll see is that when you look at it on a stock-wise basis, the underlying correction has been a lot more severe. So when you look at this, let's say even when you take the entire 500 companies, you've had the number of companies which have fallen by more than 20% was about 213 as far as small caps were concerned. Now this is 250 small caps are there. Out of that, 213 have seen this kind of a correction. In mid caps, we have 150 companies, and within that, 105 odd companies have actually seen a correction of more than 20%, and large caps has been about 57 companies out of 100. When you look at 10 to 20% correction also, you pretty much see that another 32 companies in small cap, 31 mid cap, and 28 in large cap have fallen. So when you kind of take between a 10% plus sort of a correction at a stock level, pretty much the entire universe in this thing is actually got covered, and that's where the underlying pain has been a lot more than at the index level. So which for bottom up stock pickers actually is a great setup to kind of work towards more longer term wealth creation. But it will not be a one way journey. It will have its own ups and downs. Our core belief historically, when you kind of look at this kind of data, so when you kind of take a step back, look at what's really happened, you will very clearly see that when you and equities, and typically we keep saying that it's a long term asset class. So when you kind of take a 5 year bucket, rolling bucket, and look at what have stocks done over a long period of time in that entire journey, and when you take this data all the way back to 2009, so 5 years back from 2009, and look at every subsequent year for the next 5 year rolling periods, what you'll clearly see that is that irrespective of what's happened underlying at the market level for that particular year, when you take a 5 year bucket, you will see that anywhere between 77 to 335 companies have given you a return more than 15% as per the when you look at the top row, you'll kind of see that, which effectively means anywhere between 15 to 70% of the companies kind of give you that kind of a return in any given year, which means it's our job to find out how to identify those companies, which is where a lot of research actually comes in, and a lot of hard work to identify those companies come in. And because it's not quite easy to follow 500 companies at a easy pace, which is why you need a large team, which is where our particular strength kind of comes. ICICI Prudential AMC is among the largest ones as far as equity plus hybrids segment is concerned within the country. And we, as a result of that, we also have the largest research team, which is our biggest backbone. What we are able to do as a result of this is stay a lot more bottoms up and then identify ideas. So the alternatives team within the entity functions pretty separate. And using the research that we get, we then use our own BMV philosophy to screen stocks and figure out how to do this. And we try to keep things pretty simple. This is a simple mathematical formula. For price is basically EPS into PE. So for price to do well, you need earnings growth to be there, and you need PE re-rating to happen. So if you have one of these, then it does well. If you have both of these, it actually does much better. But when you kind of look at this, again, the data 2 slides back, if you kind of bucket companies into different segments and look at what are the common threads, what you'll kind of see is that as long as earnings growth is there, and if high ROEs have been maintained over the long run, then you are able to identify a good company. These two things help you provide a good identifying a good company. Now, the reason why ROE is important is because it's basically return on equity. And who are we? We are typically equity investors when we're investing into the equity markets. So it's important to understand what is the return on equity that the businesses are generating out of the capital that we've provided. So that really, if the ROE direction is stabilizing at a high level, or if it's increasing in the long run, then you tend to get a PE re-rating. So basically, the proxy for the stock to do well, you need to look at earnings growth and you need to look at ROE improvement. If these two things happen, then you've identified a good company. But for it to become a good stock, you also need to identify them to be available at the right valuations. That's when the risk reward becomes favorable. If you don't do that, even though you might have identified a great company, the PE re-rating might not be as high. And if the earnings growth starts decelerating, then actually you will have a deceleration in terms of the returns. Which is why when you kind of look at the bottom two buckets, there is no earnings growth and there is ROE moving in the wrong direction, then there is actually huge wealth destruction. And when you look at the second bucket, you actually have companies growing at a decent clip in terms of earnings. But when the ROEs are trending in the wrong direction, then re-rating potential actually becomes far lesser. And actually, when you look at the valuations on price to book multiples, then it becomes actually there's a huge de-rating. On price to earnings, it doesn't show up as much, but in price to book basis, it actually derates quite a lot. So, which is the aspect that we always harp upon, that take a long-term view. Second, don't just go by any one particular parameter. It's important to look at earnings growth. It's important to look at ROE improvement, and it is equally important to pay the right value for that particular stock opportunity. So that's the most important thing, that you need to triangulate all these three aspects, and in a disciplined manner keep doing it again and again and again. So that's the most important thing. That's where we focus our entire efforts on. On the outlook and opportunities, when you kind of look at what's really there, we've just kind of gone past the most important event as far as the country's economy is concerned, which is the budget. So I'll kind of start off with that. The budget has been quite realistic about what they set out to achieve. I think the revenue receipts and direct taxes and total receipts, when you kind of look at that, it's looking at about 11% sort of growth penciling in. And within this, when you kind of take the personal taxation changes that they've kind of implemented, while that does reduce some amount of the receipts, I think the growth, the nominal growth of the country itself is anywhere between 10 to 12%. So in that light, this number seems reasonably realistic as far as the receipts is concerned. On the expenditure side, where people have been possibly a little bit disappointed, is at the headline level. When you look at the capex, there's only been a 10% increase, and then 10% increase has also come on the back of a 8-9% decline for 2025 in terms of versus the budget estimates. The revised estimates is for a decline, and actual numbers, it's kind of remained flattish over 2024. So that's where there has been a little bit of initial disappointment when you kind of look at that. But when you actually, and more importantly, when you look at the fiscal path, I think they've kind of done the right thing. They were very counter-cyclical during COVID, and they had invested quite a lot. So they are now coming back on the fiscal path in terms of reducing the fiscal deficit, and they're going about it quite gradually. So versus the 4.9% fiscal deficit that they kind of looked at for 2025, and the revised estimates are suggesting it will be at about 4.8, and for 2026 they're looking at 4.4%, which is quite good. Now, there is obviously fillip to spending. I think the government took the onus of expenditure over the last 3 years and did a lot of capex, and also supported a lot of growth at the bottom end of the economy in terms of the consumption, by supporting the bottom strata of the society. So I think they've largely done that bit. While they continue to support the bottom strata, what they've also gone on to do is announced this personal taxation changes, which kind of supports the middle class in the country to kind of open their purses a little bit more by giving them the tax incentive. I think that's a that remains a quite a good initiative. Let's see if the consumers respond with that kind of a change. The tax buoyancy and better fiscal kind of continue to be there. Adjusted capex, so which was the other point that I kind of mentioned, that when you kind of look at the initial capex, while it remains, while it appears to be low, when you kind of adjust it for different capexes from the public sector enterprises, the IEBR, which is external borrowings which are required, which are taken by some of these institutions to support capital expenditure. The outlined amount for that is actually quite healthy. So that number is what I think overall one needs to look at as far as government direction for capex is concerned, and that still seems reasonably significant even for FY 26 in higher than mid-teens. So that's a pretty positive outcome as far as even the capex side of it is concerned. So I think there also the other factor that the government has kind of done is whatever new industries that are emerging. I think they're giving enough incentives to support that adoption of technology in the initial stages. That handholding is kind of worked out well through the PLI initiative, which is one of their flagship initiatives. I think they've done a fantastic job on that. The outlay has increased from 3,700 crores and is likely to hit 15,000 crores in FY25, and in FY26 is further going up to about close to 27,000 crores. Now, not only that, the government is now encouraging the industry to invest a lot more in R&D as well, because what we've clearly seen is some of the other economies which have kind of grown quite fast, their ability to sustain that growth has been on the back of investments into R&D. I think the government recognizes that, and that's where in this budget they've kind of announced a 20,000 crore allocation towards R&D. Even if this particular year they don't end up spending all of it, I think it will kind of at least kickstart that, and by the next year, the government machinery, will be able to support that kind of investment, in the long run, and it's a very, very healthy sign from an economy perspective. I think that's definitely something which is on the positive side. As far as the global economy is concerned, obviously there is uncertainty surrounding whatever developments that we're seeing on the tariff side post Mr. Trump coming into power in the US. While there are tariff differentials which are being looked into, I think the trade deficit wise, India is probably the 11th on the list as far as the higher trade deficits which are there. But as far as reciprocal tariffs, which is possibly the topic of conversation last evening and today, I think India does have one of the higher gaps there, but every country has a certain natural advantage with regards to certain aspects. Say, for example, US might be a lot more advanced in terms of and competitive in terms of defense, given their technology. You can say that India is a lot more competitive in a lot of other areas, whether it is agri, whether it is textiles, whether it is pharmaceuticals, whether it's engineering goods, whether it's software or things of this nature. So I think there is obviously the cost differential in terms of labor, which accounts for a larger portion of this. Competitiveness for India to be competitive. I think so. I think at the end of the day, normal economics will kind of prevail. There'll obviously be a little bit of brinksmanship and negotiations which will be involved. But I think this period will be volatile. One can't wish it away. But I think we are headed in the right direction. Unlike other countries which run large trade surpluses, we are actually a country with that being actually on the balance. And there are a lot of items which historically India didn't get as much preference treatment like some of the other trading partners with the US got. Now, given that some of those items are also being brought on equal footing, I think it also provides a level playing field for India also to better participate in some of those areas. So, on balance, I think this will, hopefully work in favor of India, given the way it is evolving. What also one needs to understand is US is currently at near full employment. So if they were to bring a lot of jobs back into US, there are not enough people to deploy and work on that. So which is where I think there is that opportunity with India having such a large labor pool available, and given that we are a large functioning democracy with a functioning judiciary and legislation, I think it positions India in a favorable manner in the long run. That makes us quite positive about the country. Among the large countries, we kind of continue to believe that India will remain one of the more shining lights as far as the global economic growth is concerned. Now, coming to the stock markets itself, when you kind of take a step back and look at what's happened last year, we had actually a tale of two halves, where you had the pre-election period, which was a lot more risk on with the hope that the existing dispensation kind of continues with absolute majority. I think that's kind of come in with a bit of coalition, which is where there's been a little bit nervousness around some of the policies. And some of the sectors which did well prior to the elections kind of gave up that outperformance. But when you kind of look at in the second half, but when you kind of look at on balance for the full year, most sectors actually did pretty reasonably well. The only few sectors which didn't do as great despite delivering numbers could say were financials, because their balance sheets are today possibly in the best of the shape, and numbers have kind of come through. But despite that, they haven't done that great. In other areas which haven't done well, say for instance FMCG, we haven't seen as much volume growth, so that's possibly one of the reasons why while it kind of did the way it did. Last 4 years, when you kind of look at since COVID, it's been clearly a earnings-driven rally to a large extent. So in that sense, the beta of the market was also equally responsible for driving the stock returns. Even within that, I think the until then an ignored segment of the market was the B2B segment. And as the earnings in that segment kind of improve, so you can clearly see on the right-hand side chart that the earnings growth for the non-B2C was actually much superior than the B2C segment, and that's where that particular segment of the market actually did pretty well. Index EPS also, when you kind of look at 8-year period, while the first 4 years didn't do much, I think the earnings growth over the last 4 years has kind of caught up pretty well, and that's where the catch-up in the markets have also kind of happened. The micro trend, obviously, if one were able to identify these micro trends, then one was able to create a reasonable amount of alpha. And I think that's what played for people who identified the non-B2C segment improvement in profitability. When you kind of look at the period between pre-2020, the earnings growth for the B2B segment was relatively more muted, whereas post-2020, this was significantly better. So if you kind of caught that change in trend, then one was able to make decent alpha, notwithstanding just the headline movement in the markets in terms of the beta play. One was able to also participate through the alpha creation. But that said, the stage is now a little more mixed in terms of there is a bit of slower growth which was there in the first half of this fiscal. I think now we are slowly starting to see the government loosen its purse strings, and next year's budget, as we kind of highlighted, it looks on balance reasonably okay. Corporate profit to GDP seems to be reasonably better, while inflation is slightly at the higher end. I think, and interest rates are settling at a level which is higher than what we were used to between the 2010 to 2020 period. I think they're settling at a reasonably okay level. And the setup is okay as far as the economic activity is concerned. So we are quite sanguine about that particular aspect in the economy. That earnings growth is still pretty decent, but you will have these phases in the market where things tend to be a little bit more volatile, largely to do with the macro aspects that are there, and the liquidity flow which is following the same. So when you kind of look at the longer term trend, the cyclical and capital intensive businesses tend to get slightly better tailwinds when the inflation and interest rates are at a higher level. So which is where we believe that kind of still remains okay, but it will be a lot more bottom up. It is not a one-way street that you saw for this particular segment over the last 4 years. So the B2C side, you would see that they haven't participated as well in the market rally. But now, because there's been a reasonable amount of time correction, you could start seeing bottom up some opportunities starting to emerge in some of those spaces. That's something that we are looking at. And last but not the least, obviously, financials, while they've continued to do well, they've not participated in the rally as much, and which we believe actually sets them up quite nicely for the period ahead, and which makes us quite positive about that space in particular. This is largely, I think, we've kind of covered. The other aspect that I wanted to highlight was, while the government finances are also moving in the right direction, the corporate balance sheets are also in pretty fine shape. and individual balance sheets are also reasonably okay. While there is, you could say, a possibility that there's a K-shaped kind of recovery. I think with the hopefully with the support that the government has provided through the tax changes, I think we'll start to see some amount of improvement in the financials of the lower strata of the population in terms of individuals. I think the upper strata of the population in terms of the individuals is doing at an individual level is also doing reasonably well, which is where you're seeing a pickup in real estate activity in the country, and that real estate cycle seems to be in fine fettle, which is again a good sign from because real estate has one of the higher multiplier impacts on the economy. So that's again something which is quite nice for the economy. Overall, the outlook is one has to when you kind of look at the country is giving you a nice little 10 to 12% earnings growth, which is still one of the best across the world. The market is likely to be in 2025 our sense more earnings growth led. PE rating could be a little more difficult, especially PE rating tends to be a little more easy when the liquidity is light and the market in general is in a more bullish phase. When there is a consolidation phase, it tends to the opportunity for re-rating tends to be a little lower. It's more driven by earnings growth. In summary, we are more looking at things at a bottom-up basis, which is where our core philosophy is also lying. And the if one were to take a 3 to 5 year view of the markets, I think things look reasonably decent. The beneficiaries in the markets, it's going to be pretty bottom up, but some common threads that we kind of see is financials is something that's looking quite quite a good pocket of opportunity. On the capex side, there are some there's now a difference between the guys who are executing well and those that are not. So bottom up, there are reasonable opportunities. Energy is a pretty interesting energy transition is a pretty interesting development across the world, and I think that's something that we are looking at bottom up. A few pockets of opportunity available still there. Consumption discretionary is where we see a lot more opportunity, as because as income levels increase, you will kind of see that opportunities on the discretionary side are a little bit better than the staples. So that's broadly where I'd kind of leave it. Final thoughts: define who you are. Whether one is playing T20 cricket or Test cricket. I think equity markets are more like Test cricket. You have to when the conditions are overcast, you have to play the ball by its merit, and if the ball is outside the off stump, you need to leave it. And only when it comes to your playing direction that you need to play. So that discipline needs to be there when you kind of ride through that period, and when the conditions kind of improve, that's when you can start playing your shots and work your way. So I think that at the outset, I think that's something which is pretty important. You need to figure out what the circumstances are and then play accordingly. I'll kind of stop here. Yeah, be patient, because in investing, patience is a very very important virtue. I think if you're in a phase that you want to get rich quickly, then investment is not the equity investment is a more long term journey. It's not a short term journey. Yeah. And this is our final thought, I would say. Focus on what you can control. What you can't control is returns. That's an outcome. Control on what is under our this thing. Risk, cost, time, and emotions. Yeah, that's largely it. I'll kind of stop here.